Hi, good morning, everyone. Okay, so before we proceed, let's do an audio and slide check. If you can see my slides and if you can hear me, please type yes in the chat box. Thank you. All right, okay, I think the audio and the slides are showing, so we'll proceed. Thank you, everyone, for joining us in this session today for CFD Lunchtime webinar series. So my name is Zehan from the CFD department, and our topic for today is Introduction to CFD Trading and Trade Strategies for the Current Market. Okay, before we proceed, as per usual, our disclaimer for the product. Firstly, CFDs are speculative products, so it's a margin geared product. This means that your profit and losses, if you trade CFD, will be magnified compared to if you trade just vanilla stocks. Okay, then also to take note that the information that we source for this presentation are from public sources that we believe to be reliable. But from time to time, the public sources may make revision to their data, and we may not be able to capture the revision. So, so although we put in effort to make sure the data are accurate, if there's any revision, then it may not be shown in the current presentation. And the third disclaimer is that during the session, I'll be talking about certain strategies as well as certain counter picks for the current markets. But then these may not be suitable for everyone because every individual's risk tolerance as well as investment objectives are different. So do check with us or check with a financial advisor before you embark or deploy any of the strategies mentioned in this session. So we begin right away on the first part, which is the introduction to CFD trading. CFD or contract for difference is a contractual agreement between you and a company to settle the difference between the opening and closing prices of your trade position. So here we have two examples. One is a long directional trade example. The other one is a short directional trade example. So for the first one, assuming if you're purchasing 1,000 shares of Capital Equity CFD contract at $7, and then later you sell it at $7.50. So the net differential of 50 cents for 1,000 shares will be your profit. And then assuming commission on buying and selling of $25 per leg, then the net profit will be $450. And conversely, if you do a short sell of 1,000 Capital contract at $7 and later you buy back higher at 750 cents, so this means that your loss before commission will be $500, and then after including commission, your net loss will be $550. So for CFD, you can do both long and short directional trade to maximize on the current market trends. So why do we recommend CFD for short selling? Is because with CFD, you can short sell very easily with just a few clicks of the mouse. And no need to call us or email us. You can do all this online. So the prerequisite will be you need to have a CFD account and you need to have sufficient deposit inside your CFD account. And then with CFD, it's also a geared leverage product. So you can trade up to 10 times leverage for equity CFD and up to 20 times leverage for index CFD. If we compare this to normal stocks trading, we see that for normal stocks trading, you cannot do short selling of foreign shares and you can only short sell Singapore share, but with a very limited time for you to close out the trade. So if you short sell CFD, if you short sell Singapore shares on your normal stocks account, you will need to buy back the share on the same day. Otherwise, your account is subject to penalties by SGX if you let the short sell trade carry overnight. And also, if you wish to resolve the short sell, you need to call us and go through a multi-step process to borrow shares. And also, you need to inform us again when you buy back the share to return the share to us. So all this will add to more work on your part if you wish to short sell Singapore share using your normal account. And for this reason, we recommend that if you wish to look at short selling, whether is it for Singapore share or foreign share, to do short sell using CFD. Or because you can do all this online without needing to inform us or anybody in our company, or just short sell online. And then, of course, with our normal stock trading, it may or may not come with leverage. It will only come with leverage if you're using a margin stocks account to trade. Now, so we talk about leverage. It is also known as a margin or gearing. So we say CFD is a margin type account, or because every trade you do, it will come with a natural gearing in it. And then with this gearing for CFD trading, your net profit or loss for CFD trade will be magnified compared to if you trade just vanilla stocks. So here we have an example. If you have 10,000 cash in your CFD account, and then you buy $30,000 of trade position, also meaning you're using CFD with a 3 times gearing to do this trade. And then assuming if markets move in your favor by 10%, your profit because of the 3 times leverage will be 30%. Also compared to someone who's trading a vanilla stock, if the profit in the market is 10%, in the cash market is 10%, your profit for CFD trading due to 3 times gearing will be 30%. And then conversely, in the assuming if the market move in the other direction or against your favor by 10%. So a client with vanilla stocks trading will lose 10%, but if you use CFD to trade, then your losses will be 30%. Okay, for CFD trading, we offer these products for you to consider. So you can trade equity CFD, you can trade index or ETF CFD, you can trade commodities CFD, as well as Forex CFD. So over here at Phillip, we offer more than 3,000 equities and ETFs contracts across 11 major markets. So any stock that you want to trade, you can most probably find it available for CFD trading as well. So we offer trading of the most popular counters across all markets. And if you are looking to trade indices, you can also consider our in-house equity index. We currently offer 15 of them across US, UK, North Asia, as well as Southeast Asia, Singapore and KL index. If you are looking to trade commodities, we also have contracts for them. These are in-house contracts as well, available for US oil, UK oil, gold and silver. So you see the dollars amount behind the contract name. Those refer to the profit or loss you will make per point movement of the index or of this index contract. So let's say if it's $100 USD, it means that every 1 point up or down will be $100 profit or loss in your account. At the moment, we also offer trading of Forex CFD. So we currently have 36 currencies pairs. Most of the major currency pairs will be available for trading. Say dollar yen, dollar euro, dollar pound, and dollar Sing dollar. And also one thing to note is that we also offer dollar renminbi contract. Because the renminbi is a controlled currency, so not many companies offers is trading. So if you wish to trade renminbi versus the US dollar, you can consider using CFD or to trade as well. And moving forward, we will also be launching the dollar Thai baht currency pair, which is also quite a unique currency pair. So you can use Phillip CFD if you wish to trade dollar Thai baht movements. Okay, so how do you trade CFD? Okay, so currently we offer CFD trading across various platforms, including for Poems Internet. If you're using a computer or laptop, you can log into your Poems account and then you can trade CFD there if you have a CFD account activated. You can also trade CFD using our mobile app, so you can trade CFD on the go, or whether you're traveling or you're outside for lunch, you wish to monitor prices, you can log into your mobile app to check and monitor and trade. And also, recently, we also launched a CFD trading on MetaTrader 5 or MT5. Or this is a new platform facility that we are launching. So you can request for access to trade Meta 5, MetaTrader 5 from POEM's internet. And this is how you can request the access. First, you log into POEM's internet on your computer or laptop. Then you click on account management, CFD, and over there you'll see a MetaTrader 5 item there. You can click into it and then you can add MT5 CFD account. And then you'll receive an email with further instruction on how to get started on CFD trading on MT5. Okay, so now we move on. So the first part was the introduction to CFD. Now we move on to the second part, which is a closer look at across the market, the current market trends, and how you can deploy strategies in the current markets. Okay, so first up, we look at the US, which has a global impact, or the US stock market and its macroeconomics has a global effects around the world. So front and foremost, we look at US inflation, right? So the latest US inflation data just announced, I think about 2 nights ago on the 15th March. And thankfully, it's still coming down. So the latest inflation rate on the headline CPI is 6%, down from 6.4% in the prior month. And then for core CPI, which is CPI excluding the more volatile food and energy sector, core CPI is also lower at 5.5%. So what do we deem from this? What do we glean from this latest release of the data? So we see that the downtrend is still continuing, and yeah. So for headline CPI, we see that it is continuing 8-month downtrend, which is what we hope to see. But for the core CPI, it seems to be bobbing up and down. So we see that since the beginning of this year, it hasn't really come down much. It came down for a few months and then rebounded for 2 months, and then it's coming down again for the 5th month. But is still proving to be quite sticky at the moment. So we're hoping to see more deceleration in inflation, especially for core CPI, in order for us to really see the effect of financial tightening on curtailing price inflation in the US. So, and then if we look at the table on the right, okay, this one shows the CPI and core CPI data since January 2021. So we see that before this whole situation of high inflation began, right, in January 2021, inflation in the US was only 1.4%. And then it was only around April that it started to surge up. So in April, it went up to 4%. And then in May, it started to cross the 5% level. And then October crossed a 6% level. And then finally reached a peak in June 2022, about 9 months ago, or it reached a peak of 9.1%. And then after that, then we see in the second column set, okay, then inflation is coming down from 9.1% in June, and currently we are at 6% for headline CPI. Yeah, so of course, the Federal Reserve's mid to long-term inflation target is at 2%, which is shown by the horizontal line shown in the chart. So at the moment, with headline CPI at 6%, core at 5.5%, we are still quite far from the Fed's long-term target of 2%. Okay, and then if we take a closer look at the inflation data for February, we see that there's improvement in the inflation data, price pressure for food and energy sectors. So these are shown in green. So we see that there's some deceleration in price pressure, most significantly in energy across almost all energy sectors. All energy segments are showing positive sign of easing of price pressure, which is what we hope to see. But then, of course, as we mentioned, these only contribute to headline inflation. It doesn't contribute to core inflation. So core inflation is determined by various other segments. And then if you were to look at the segments highlighted in yellow, we see that these still remain very elevated. Services segment, less energy services, is still elevated at 7.3%. Shelter increased from 7.9 in the prior month to 8.1% in February. And transport costs continue to hover above in double-digit zone of 14.6%. So in order for core inflation to come down, we will want to see more deflation across these three sticky components. And then here's a look at US inflation data for the last 60 years. So we see that in the US, high inflation had occurred before in the late 1970s in the first episode, where it surged up to a height of above 12%. And then after that, it did come down in the late 1970s, but then it was quickly followed by a second wave. And this second wave came in even fiercer. It causes inflation to rebound and surge up to more than 14% or in the early 1980s. So if we, because these two episodes occurred back to back, so in the US, there was this period of almost 10 to 15 years where inflation was very high, or more than 6%. Or you can imagine inflation at more than 6% and then persisting for 15 years. So that's a very tough environment to be in, or whether is it for individual or corporates. Yeah. And then after that, thankfully, after the early 1980s, there was a very long period of relative calm. For 40 years, the next four decades, inflation was very well controlled at below 6% most of the time. And then, of course, due to COVID, then we are currently seeing this a resurgence of inflation again. But thankfully, this time, this episode, the inflation in the US only reached a peak of 9.1% in June last year, and did not reach the same height or velocity as the episodes experienced in the 1970s and 1980s. And okay, and also in order to curtail this this high inflation situation that we were in, right? The Fed had been hiking interest rate since March of last year, or they've been rising interest rates um, to try to temper down consumer demand, or and to cool down the overheated economy. So we see that from March 2022 until February, right, last month, they have hiked rates about 8 times for a total of 4.5%. Also meaning within a short span of 12 months, they have hiked rates from 0% to 4.5%. And then the current market forecast is that the Fed will still hike rate one more time in their meeting next week, which will end on 22nd March. But then after that, they may pause, or in May, they may not proceed with further rate hike. And market are even anticipating that in June, the Fed will look into cutting rates. This is quite a material change in sentiments across the market watchers, because even as early as last week, we were expecting the Fed to continue hiking interest rate for at least 2 to 3 more times. But due to the US bank crisis that has unfolded in the last 1 week, sentiments have changed, and people are now expecting the Fed to do a rate cut even as early as June of this year. So yeah, okay. So then so what happened in the last 1 week was that the most significant one is the collapse of Silicon Valley Bank. So this bank, this is a regional bank in the US. And then what happened was that in since 2021, they have been accumulating investment into bonds. And then in 2021, they did a big investment across the year into bond. But then what happened was that last year the Fed started to hike interest rate, and then with a rising interest rate, right, the market value of the bond will drop, and then also with the increasing interest rate, uh, venture capitalists were less inclined to lend out their money for investment, or to put money into investment. So due to this dual effect of a drop in the investment in bonds, as well as this reduction in fund flows from the venture capitalists. So the Silicon Valley Bank start to find themselves in this situation where they have a cash flow crunch, or they are not able to find sufficient liquidity um, to operate their business. And then so last week they announced that they book a loss in a bond investment. Okay, let me see. I think it's on the next slide. Oh yeah, right. So sorry. Okay. So they on 8th of March they announced a booking of a loss of 1.8 billion in their bond investment. And at the same time, they announced they want to raise fund or via a stock sale. They want to raise 2.25 billion of fundraising. But then on hearing this news, right, Silicon Valley's bank's customers, they feel that the bank cannot sustain this situation. So they rush in to withdraw a total of $42 billion of deposit. So imagine the bank is already short on cash. They are doing a fundraising to raise just 2.2 billion just to operate, but then you have customer requesting to withdraw $42 billion. So due to this bank run, right? This what we call a bank run, where customers are rushing in to withdraw money from the bank. So SVB was forced to close down, and then in a very short period of less than 3 days, or they've closed down, and then they were taken over by the US authorities to try to assure the public that the government is in on this, and then not to worry and not to cause further panic. Yeah. And then, of course, in the aftermath of the collapse of Silicon Valley Bank, we see that other banks were also affected. The most notable one will be Signature Bank, as well as this First Republic Bank. So we see this is still trading, whereas versus Silicon Valley Bank, this has already stopped trading. So Silicon Valley Bank, right, we see that it was trading at $300 prior to the announcement, and then following the bank run, it dropped to just $100. And then even in the aftermarket hours, it dropped even further to just $40. We have a client who purchased it at $60, but unfortunately is not able to sell it currently. So at the moment, the money is locked in. Yeah. And then for First Republic Bank, it's almost the same trend. We see it was trading at $120 prior to the crisis, and then currently it's only trading at $33. So why are markets, what are the current worries in the market at the moment? So besides the bank crisis, right, one other worry that is on the market's mind would be whether there's a looming recession or around the corner, because we are currently in this Fed rate hike cycle. And then if we were to look at history, right, in the last 70 years, the Fed rate hike cycle is always followed up by an economic recession, or where people, there'll be quite material job losses, and then there'll be business closure, or in recession. So if we were to look at this 70 years chart, we see that the red color line, right, is where is the Federal Reserve fund rates. And then even as early as 1950s, whenever the Federal Reserve raised their rates, is followed by a recession. So so will we also encounter this in the current rate hike? This one we will have to check and monitor again in the coming months. So and then, okay, what the Bloomberg team is saying that is that in one of the articles in October 2022, they are saying that it's 100% chance that there'll be a recession within the next 12 months, or from October 2022. So will they be right? Because this one we will have to check again, maybe end of this year or beginning of next year, to see how accurate is the Bloomberg team. but the thing to know is that they are very certain because that's why they publish this. They dare to publish this and then put this as 100% probability of a recession or in this coming 12 months. And then, but if we were to look at the US quarterly GDP, okay, we see that in the US, they actually already had a recession in the early part of 2022. Okay, so in the first quarter of 2022, the US GDP was at minus 1.6%. And then for the second quarter, it was minus 0.6%. So the traditional definition of a recession would be if there's a two consecutive quarters of negative growth, or then it's called a recession. But then many are saying that it's not a real recession because due to all this unusual situation brought about by COVID. So and we tend to agree with the consensus that the US is not yet or has not encountered a recession in 2022 because there wasn't massive job losses that would characterize a traditional recession. So if you were to look at the US job market situation, we see that currently the US labor markets are still very tight. Especially the unemployment rate. The latest rate is at 3.6% for February, and this is near a 4-decade low. Or normally, unemployment rate will be higher. So in fact, 3.6 is near a 4-decade low, or it's almost like the lowest rate for unemployment really. And then if we were to look at another measure, right, of employment situation, the initial jobless claims, this one is when in the US, if you are unemployed from your job, you can submit a claim to the federal government or to have some help financial assistance. So this one will keep track of the number of people who is submitting claim, and it is indicative of it provides some color to how the situation is for US labor market. And then if you were to see that the latest rate, right, is only at 211,000. This one is not very high. This one in fact is trending more to the lower end of the normal range. Also, if you were to look at normal levels, right, it can be higher around, especially if you're talking about a recessionary period, then we will see it above 300% definitely. So for now, it's only at 200,000. So the job situation in the US is still very positive. In fact, it's better than normal times, I feel. Then another measure is the new jobs creation. So we see that the latest rate is at so it's not 311. I think it should be 200 something. It's not 311. No, sorry, it's 311. Sorry, the latest rate 311, which is still a very high number because in normal times, right, this new job creation is only around 180,000. So 311, it means that the demand for people to fill jobs, or there's still a lot of vacancies in the US. So people are still able to find job, not too difficult. They still able to find job quite easily. And then of course, then the fourth measure is the average hourly earnings. This one is also will fit into inflation. So this is one parameter that the government, US Federal Reserve and government are also monitoring. So the latest rate is that the wage growth for February is at 4.4%, versus in normal time it should be around 3% only. So if we were to look at this wage growth rate, right, it is still feeding a bit into the inflationary pressure in the US. And then another ratio that we look at is this job vacancy to job seeker ratio. In January, this came in still at 2 to 1, meaning for every one person seeking job in the US, there are 2 available job vacancies to fill in. So this is still very high because in normal time, it should only be around at 1.2. Okay, then of course, then the question is, how come we are still seeing news about layoffs in the US. Even as early as 2022, we start to see all this news. I think in order to explain this discrepancy, right? How come the job market is so tight, but then the media is still uh, publishing news about layoff? Yeah, I think if we were to look into them closely, right, we see that all these market are high profile tech companies mostly, because uh, their online business grew a lot during the COVID years. So during the COVID years, they have to increase their hiring by several folds or several percent. So due to this excessive hiring in the last 3 years, right? Because now we are all almost back to normal times, where people are going back to office to work, not spending so much time online, or whether is it on the cloud or is it e-commerce or social media, right? So that's why we are seeing all these high profile tech companies are finding themselves in an overhired situation. So uh, at the moment they are letting go some of their staff, which is why I think this could be one of the reasons why we are always seeing news about layoffs by these high profile companies. Right. Okay, and then yeah, this one's housing. Okay, so in light of all this situation, right, where inflation is coming down, there's a chance that the Fed could pause or slow down their rate hikes, and the job situation in the US still remaining tight. So how should we deploy, or what kind of strategy should we adopt in the current market environment? Okay, so if we were to look at the SPY, which is the S&P 500 ETF, we see that it had been on a downtrend since 2022, but in the recent few months, it has kind of stabilized. It is more trending sideways. Oh, so I would say we are currently in a sideways trending market lah. Oh, um, not yet on a recovery path, but probably could still trade sideways for a while. And then this is for the triple Q, which is for the Nasdaq 100 ETF, and we are also seeing a more or less similar trend. On the side, trending is also is more obvious on the S&P 500. Is probably only just beginning for the triple Q. Yeah. So in the current climate, right, we would recommend, especially due to the current levels of the index, to do a long trade at opportune time for US indices, or especially if you feel that they are oversold or due to fear or panic in the market. So the reason for this is that my personal view is that the US market is probably moving sideways for the near term, and it will be range bound. So in this market, you can do a buy trade if it's oversold, and then there will also be opportunity to short sell later when it's in an overbought condition. So for CFD, right, why trade using CFD and not normal stocks or ETF? Okay, it's because CFD will allow you to flexibly change your trade direction. So at the moment, you can do a long trade, but then if situation turns, you can quickly uh, switch your long trade to become a short position. Also, CFD allows you to do this easily. You can open and close out your short trade, and then you can reverse the trade very easily. So what are the recommended CFD contracts? Would be the S&P 500 index contract. This one comes in the $1 and $5 version. So depending on how big a trade you want to go into, you can consider the $1 or the $5 contract. So these track the S&P 500, and then we also have the US Tech 100, which tracks the Nasdaq 100 ETF. And then we also have an in-house Wall Street Index CFD contract. This one tracks the Dow Jones Index. Okay, so this is a look at the technicals. We see that currently, due to the banking crisis, right, the US is creating a lot of fear. So markets, the S&P 500 has sold down quite a bit. I would say it is now trading at a near-term support level of around 3,800. And this is also supported by the RSI, the Relative Strength Index, because this RSI measure is a measure of whether a stock is overbought or oversold. When it's near the 30%, it means that it is probably oversold, and which is the situation that we are seeing at the moment. So, but of course, depending on how the situation unfold in the US, it can still trade lower. So, but at the moment, the S&P 500 seems to be nearing a support level. So, some trader may find it a good time to do some accumulation at current levels. And this is for the US Tech 100. Similarly, there was a sell down in the last few days. But the situation is not quite oversold yet lah. It is just about midpoint. So we don't know whether it may still trend now if those fears start to build up again in the US market. And then this one is for the Wall Street Index, which tracks the Dow Jones. This one we also seeing a sell down in the last 1 week because many of the financials are inside. Okay, so all in all, we see all three indices, right? Seeing some kind of a sell down in the last 1 week. So there might be some value there to go long at opportune time. So that will be one strategy you can consider to buy long on US indices in an oversold situation. So, but of course, if you want to use this strategy, you have to still monitor to see whether inflation continue to trend down or is it remaining sticky. Because as we seen earlier, certain core segments of the inflation matrix are not yet coming down. So if they remain high, then the Fed may need to do more tightening. And then, of course, the next thing to look out for is the Fed action. Are they, in view of this banking saga, right? Are they looking to slow down, pause, or even reverse the rate hike? Or if yes, right, then we could start seeing a bit of recovery in the indices, and then so there might be opportunity for you to profit if you go long in this trade. Okay, and then next we move on to China Hong Kong. Okay, for China Hong Kong, we are seeing also a similar trend. The A50 has been trending down since 2021, and then it's only quite recently in the last few months we are seeing a bit of a rebound, and presently it's also moving sideways. Or not yet a recovery, but it's probably just sideways trend. And then things to note if you wish to trade China Hong Kong, right, is the situation between China and the West, which is led by US. So we've seen that even as early as August last month, there's been quite a bit of tension, especially over Pelosi's visit to Taiwan. And then these were escalated further because US started to impose restriction on chips import or export into China. So at the moment, and then of course in February this year, there's this the episode with the spy balloons, and then recently US announced a deal between US, UK, and Australia to supply nuclear power submarines to Australia. So all these are adding to tensions, adding to caps on Chinese recovery, Chinese market recovery. Okay, and then taking a closer look at the impact of US restriction on chip export to China. So we see that in the last few months, right, the US have been trying to curtail Chinese tech development. So they spoke with Netherlands, they spoke with Japan, and then they spoke with domestic chip companies or US chip companies not to ship advanced chip making equipments or advanced chip to China. So all this is to curtail Chinese rapid development in tech. So Due to this, all these measures by US, right, all this restriction by US, the Chinese industries are starting to feel the impact already. So in December 2022, right, 22, Huawei announced that they ran out of advanced chip for their smartphone. And then the Chinese equipment import also plunged in November. And then their domestic smartphone shipment also fell in December. And then more recently, for the AUKUS deal, right, the Chinese are unpleased with it. So they have voiced some of their concern, especially about nuclear proliferation. But all in all, I think the approach or the reaction by the Chinese government is a very well controlled, very measured. Sorry. So they just finished their 2-session event, and they now have a new team in the government. So the China's new premier, like Li Qiang, he recently responded at the news conference, and the tone was very conciliatory. And then also, we see the Chinese starting to exert a bit of international influence. So in the news recently is that Xi Jinping will talk with Zelensky from Ukraine after meeting Putin in Moscow. So what we are seeing is that they are trying to help resolve the dispute, which is actually good news for on the international stage. And then, of course, they are reopening borders. And in recent news conference, right, we get a sense that the Chinese government is more focused at domestic stability. So, and also to counter the US curb on chips. And so these are some of the current developments in China. Yeah. So in view of these recent events, right, the strategy for China, Hong Kong will be similar to the one for US, which is to buy long in an oversold situation. Because again, we feel that development for China, Hong Kong market is likely to be range bound for the near term. So CFD contracts that you can look at will be China A50, the H-share index, the Hong Kong index, which tracks the HSI, and then the Hong Kong Tech Index, which tracks the Hong Kong Tech Index, or as the name suggests. So all these are different ways you can gain exposure through CFD into China Hong Kong market. Okay, so if you wish to trade China Hong Kong, right, one thing to look out for would be again the relation between the competition between US China and what the West is doing to curtail growth and recovery. So okay, so besides so one thing to know is that the excessive growth and return, right, by Chinese stock, tech stock, in 2020 in previous year, we may not see it in the near term, or because of many things, not just because of the cheap curbs, but also because of domestic regulatory oversights. So if you recall, last year, the Chinese government have been cracking down on various sectors. So with every crackdown, right, they are also putting in place tighter regulatory oversights. So all this will also add to challenges for the Chinese tech companies to find the kind of growth that they experienced in previous years. So another thing to note for Chinese stock is that due to the reopening and focus on domestic economic recovery, so certain segment may see a boost, or especially tourism related segments. Obviously, they are focused on also reviving tourism. So for these are the support and resistance level. Support is at around 1250 and resistance at 14500 for the A50. And then for the Hong Kong index, support is at 118,200 and resistance at 22,500. And for the Hong Kong Tech Index, support is at 3006, which is near the current price level. And you can look to sell if it's trading near resistance at 4008. And since we're on the topic of China Hong Kong stocks, we'd like to also inform you about our current offer if you trade Hong Kong counters on CFD. So you can scan the QR code on this screen to read more about the details of this offer. But the summary is that if you with this current campaign, you can trade selected Hong Kong equity contracts from as little as 1 unit per trade, and you will also enjoy a reduction in the minimum commission to only 50 Hong Kong dollar. So this campaign is only available for 100 selected Hong Kong counters, and most of the popular traded counters are inside. So you can find stocks like Alibaba, JD, Tencent, Xiaomi, Meituan, Baidu, Geely, Ping An, China Life inside. There's also the casino stocks, Sense China and Galaxy Entertainment, as well as ETFs, such as CSOP A50 and the HSI ETF are all included in this campaign. So this will be valid until 31st December. So you can take a look at this if you wish to trade China Hong Kong counters. So it's a trade from as little as 1 unit, or no need to trade in the bigger lot size. You can trade from 1 unit, and you will receive lower commission on your trade. And enjoy lower commission on the trade. Okay, and then for this fourth part, we are looking at the strategy for Singapore. So for Singapore, inflation follows a similar but not identical trend to the one in the US. So we see that in Singapore, in the 1970s, inflation also reached a peak, went up very high to more than 33%. And then this was followed by a second wave in the early 1980s, but the second wave is lower and only in excess of 10%. And then this was followed by a few decades of calm. And then we are seeing, of course, another wave recently due to COVID. But for the current wave, we only reach a height of 7.5%. And similar to the US, inflation in Singapore is also coming down. So presently, for January, the rate is at 5.5%. Okay, so for Singapore, right, our approach will be slightly different now compared to, say, for US or for Hong Kong. So for Singapore, we will recommend to look at Singapore counters, which are paying a good dividend. So by good dividend, at the current market, we will feel it's more than 5.5%. And also we will look for counters with a potential for upside price movement. So counters that fulfill these two criteria, right? These two selection filters will be Propnex, Escort Trust, Ascenders REIT, Netlink, and possibly Keppel Pacific Oak. This one I'll talk about later. Yeah. So this one is my most favorite counter at the moment, Propnex. It's currently trading at 1.85, and our target price is $2. So the reason why we recommend this is that it has a high dividend yield of 6.8%, and they have a huge earning beats last year. And the earning beats was despite a 28% year-on-year drop in private resale volume. So although the general market seeing a 28% drop in volume, but they still managed to outperform by a lot, and then they see a huge earning beat for last year. And then the forecast for Propnex for next year, right, is also still quite positive, because at the moment they have already managed to secure exclusive marketing mandates for 35 projects for 2023 this year. Versus so this year they are looking at already, they have 11,000 units for new property launches that they can sell. versus only 4% secured new project units for last year. So this year they got more things to sell. So we feel that there's still growth potential in the stock. Sorry. And recently our research analyst, Mr. Paul Chiu, he also upgraded the counter from neutral recommendation to buy. And of course, this is already partially reflected in the share price. So last month when I was talking about this counter, it was only trading at 1.67. So this is last month's price, 1.67. Currently it's trading already at 1.85. Yeah, so the price has already moved up. But then even at 1.85, right, the dividend yield is still 6.8%. Or last month was about 7.4% at 1.67. So if you're looking for a counter with a good growth outlook, also good dividend, then Propnex is one counter that you can consider, but maybe not at current price. If it drops down, then you can start to buy a bit. Okay, then the second counter that we look at is CapitaLand Escort. Okay, this one is currently trading at 1.01. This one is the correct price, 1.01. Dividend yield is at 5.53%. Still one of the highest among hospitality REITs. And the good thing about this Escort Trust is that it is a Temasek Link. It's a CapitaLand company, Temasek Link. And Temasek owns almost 1/3 of shares inside. So in terms of support, the government support is definitely there. And then they have an international portfolio across global countries. And then recently they acquired 9 new properties. So they are still on an expansion path. Or despite the last 2 to 3 years of COVID, they are still expanding at the moment. And they are looking to move into longer stay accommodations, such as a student hostel and service apartment. Because all these are contracted stays, so they will provide more visible income flow. So they hope that these longer stay accommodation will form around 25 to 30% of their income source moving forward. And then RevPAR currently is almost at 100% ready of pre-COVID level. But then if the recovery continues to resume, right, then RevPAR could exceed 100% of pre-COVID level. And the good thing about Escort is that almost 80% of their debt are fixed. So they managed to keep their borrowing cost at only 1.8%. So despite all these few months of a high interest rate, right, Escort is still able to borrow at the aggregate borrowing cost of only 1.8%. And the gearing ratio is at 38%, still below the 45% level by MAS. Okay, so the current price is 1.01. Our target price is 1.26. And this is a raise of the target price from earlier 1.13. Okay, the third counter that we are looking at is a CapitaLand Escort. That's a Ascendus REIT, currently trading at 2.8, and our target price is 3.3. So similarly, this one gives a good dividend of 5.8%. And in their latest earnings result, right, they give very positive update. The portfolio occupancy is at a 10-year high at 90, almost 95%. And then due to this very strong demand for their property, right, under Ascendus REIT, they are able to do a positive rental reversion of 8% across their portfolio. So this is we are looking at almost 30% rental reversion in the US. Also, the demand, the property demand in the US is still very strong. And then the outlook for 2023 is a mid-single digit positive rental reversion. So meaning they're still looking at further rental reversion for this year. And leverage ratio is healthy at 36%. And again, almost 80% of their borrowing are hedged. or at the cost of a quite low cost of 2.5%. So all in, I would say it's still a good counter. And this is the chart. Currently is trading near the support level. Okay, then the fourth counter we are looking at is a Netlink. Okay, this one gives a dividend yield of 6%, which is quite, I would say quite decent, 6%. But then rising interest rate and inflation may add to the expense. So effective borrowing rate is at 1.9, which is also very low or very well managed. And 75% of their loans are hedged. And they will only look to refinance. They will only be forced to refinance in May 2026, or which is still 3 years away. So all in all, the loan, in terms of the loan ratio, all these will be very stable for at least a few years, or they will not need to refinance at high interest rate for at least the next 3 years. So also because they are in this market, in this business of cabling, right? Network, fiber network cabling. So and they service the Singapore market. So in terms of customer, it is very stable. But of course, with stability, the bad news is they cannot grow also, or they cannot expand. So at the moment, I think they are quite saturated. So we will just put this as a accumulate, just for the 6% dividend yield. But in terms of growth, it may be a bit limited. But then if we were to look at the share price, right, it may offer some value in terms of the share price, although the business is saturated. But then it's currently trading near support of 85 cents only. So if you were to see normal times, it's actually trading, could be trading higher. So this one also offer a bit of a capital gain opportunity in addition to the 6% dividend yield, which is why we are recommending this. And then the last counter that we have is the Keppel Pacific Oat, currently trading at 44 cents, and the market target price is 68 cents. This one is a bit of a risky counter, so it's not recommended for all trader. This one is only for certain segments of a trader, or maybe the more experienced one and more risk tolerant clients. Right. So the reason why we recommend this is that it's giving a dividend yield of 13%, and the fundamentals are, I would say, still very strong. They have a committed occupancy rate of 92%, and 77% of their debt are hedged, and they do not need to refinance until the fourth quarter of 2024. The all-in cost of debt is at 3.1%, and weighted average term to maturity is almost 4 years. So this table, this picture shows the debt maturity profile. So we see that they don't have any debt requiring refinance this year. And in terms of the tenant concentration, is very diversified across various segments. They have tenants in tech, they have tenants in finance and insurance, media and information, as well as medical and healthcare. In terms of their distribution, right, is also quite diverse. They are diversified across geography as well as industry. And then in the US, we're also seeing a return to office trend. It is still continuing. So as of current, right, the rate of physical occupancy has rebounded to 60% as of February. So all this will be favorable for a recovery in office space demand in the US. And this is the chart showing Keppel Pacific Oat REIT the counter. It is currently trading also at support level of 44 cents. So yeah, that's the last slide for the market outlook. And now we look at the promotions that we are having for clients. So besides the micro Hong Kong CFD trading offer that we are also having this frequent trader program for our clients. So if your CFD commission is more than $500, you will receive CFD trading credits from us. And if your CFD commission for any month is more than 2,000, we will lower commission for you automatically for Singapore, US, and Malaysia CFD. And we also have this ongoing refer a friend program. So if you are an existing CFD client and you have friends who wants to trade CFD, you can refer them to us and you will receive $150 CFD trading credit, and your friend will also receive $150 CFD credit. So before you embark on this referral, do inform us, because we'll need you and your friend to fill in a form. Also, because we need to make sure that these are actual referrals. Because previously we have clients who refer people to us and then only inform us a few months later. So we couldn't verify that it's a real referral, so we couldn't extend the referral offers to both the client as well as his friend. So do take note, if you wish to refer your friends to us, do inform us first, because we need you to fill in some forms to be eligible for the referral entitlements. Right. Yeah, so a summary of the three strategies we have mentioned in this session. For US, we are looking at a sideways range bound market. So to buy long in an oversold situation and to short sell when the rally is overbought. Yeah. And this is a similar strategy for China, Hong Kong. And for Singapore, our strategy will be to look into counters with a good dividend yield. And the 5 counters we mentioned will be Propnex, Escort Trust, Ascender Suite, Netlink, and Keppel Pacific Oak. But Keppel Pacific Oak is for the more risk tolerant customer, because there's high risk if you buy into Keppel Pacific Oak. But of course, if you were to look at the chart, it's trading near support, and and it has a rebound just a few months ago, and the rebound was very strong, more than 20% within a few weeks. So these are our contact details. If you have any question or if you wish to contact us, you can call us at 68121555, or you can email in to tq_team@phillip.com.sg. You can also call our CFD general inquiry number at 6336-4564, or email in to cfd@phillip.com.sg. And that's the end of the presentation. We are now going to question and answer. Okay, so we have a question from Mr. Alex. Why does Poyon's platform allow only same-day validity? Okay, this one, I will need to look into this with our product team to see if we can make any enhancements to our platform to allow for maybe GTD. Yeah. So thank you, Mr. Alex, for your feedback. We will check this with the product team. If you have any question, do type in the Q&A. So we will have maybe 1 minute for any clients who want to ask question. All right, sorry. I think there's no question at the moment. Oh, sorry, there's one more question. Okay, for the Hong Kong micro CFD trade, uh, will the minimum $50 fee apply? Yes, the minimum $50 fee will apply, even if you trade just one unit. Okay, then there's one more question is, if one has a POEMS account, still need to open CFD? Uh, yes, because by default, your account will only be activated for stocks trading. So you can trade CFD, you can trade stocks, ETFs, and unit trusts without opening further account. But for CFD, you need to activate it, and then we will activate the CFD ledger for you. Also, do contact us or your trading representative if you wish to activate your account for CFD trading. All right. Okay. I believe that's all the questions that we have currently. Thank you for your audience here today. If you find this session to be fruitful, you can join us again for subsequent session. We'll be having this session on a recurring basis. And we thank you for your support, and we hope to see you soon.